All right, stocks settled down after yesterday's big move to the upside, but we kind of settled down to where we were before that rally began, before the decline. So, take out the decline, take out the 4-day rally before that, and we're pretty much at the same spot. So it's like 5-day. You just basically took a week out, a week of anticipating the CPI report and a week of digesting it, and we're at the same level before we were when we tried to front run it. So it's kind of interesting that as volatile as the market's been, it really hasn't been that volatile. It's just, again, a lot of people got caught off sides or trying to front run what they thought would be a really weak CPI report because of gas prices falling and producing the fuel for that year-end rally that some people are expecting back up to new highs. So that obviously wasn't the case, and we're still back to where we were. And we're still on a bearish trend, and we're still correcting to the downside. And the question is, are we done? Where's our support? What do we have to get through? What are the indicators looking like? How bearish are we? Can we expect to continue to be bearish? I mean, that's what we all want to know, and that's why I broke down in today's video. And I'm going to break down a couple really important long-term market forecast signals. Since, again, I won't be here on Friday. I won't be here on Monday. We'll be out of town watching the Cougars, BYU Cougars, take on and defeat, hopefully, the Oregon Ducks up in Eugene. So I'll be back next Wednesday, but because of that, this week ends a week as well as a options expiration cycle. So I'm going to break down some couple really important indicators off both those time frames and see how we've responded to them since we got them and what that means in terms of our long-term expectations. Let's go ahead and get started. Today is Wednesday, September the 14th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. And before we get started, I invite you to subscribe to our YouTube channel with this icon right here in the bottom right corner of your screen. Hit that thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, come down here, check out some of our classes over here on the right. Come down to the bottom, click that heart, it opens up this tab. Hit that like button, and again, also click the thumbs up icon. It opens up this tab, and hit that like button. Again, the more you do that, the more you comment, the more you share, it really helps our content help us get our content out to all of our social media, our followers on those social media platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see, again, we rallied today, but we didn't really. I mean, it's a very small range after a tremendous range yesterday, 3 times the average. When you include the gap, we ended up with, or at least double the average, we ended up with a very, very small range, just barely more than half. At the lower end of the range, too. So we ended up just kind of staying down at the bottom of yesterday's big range. Not surprisingly, the intermediate line turned back down. Still sits in bearish territory there. The near-term line, after the momentum line hit extreme or close to extreme lows, the near-term lines also dipped well into the reversal zone. Again, that doesn't happen when you're bullish, right? You can see the near-term line when it gets bearish, it doesn't dip that much when you're bullish. It only gets down here when you're bearish, right? And we have, again, dark pink shading and a red line. We're nearly 4% below the moving average, so we're more than that 2.5%. We are definitely in a bearish mode. What we're not, however, is still below this important Fibonacci retracement levels. All 4 of these. So the orange line is based off the year-to-date drop. The green line is based on the current leg lower that we're retracing, because this is the current retracement, right? And then remember, the retracement doesn't end until you get back below those. So we've been retracing both legs, the long-term leg and then the current intermediate leg. We've been retracing both of those, and we haven't ended the retracement yet. And of course, you have these 2 very long-term support levels, the 23% retracement of the post-2009 rally, and then the 38% retracement of the post-COVID rally. So we've already faked out once there. We broke down, came right back up. So we had a little bit of a fake out there, and now we're close to testing those again, or at least sitting on the first one, right about 39.20, and of course the last one's right around 38.20. So we'd have to kind of pierce through down there. Probably will take a few days if we get below those, but if and when we do, then that will be relatively bearish because, again, like I told you over here, when you retest an area that you had a fake out at, it tends to not be a fake out the second time, right? So that's what we're looking at there. When you look at the long-term market sentiment, still rising. When you look at the NASDAQ, it looks very similar, almost exactly the same. You look at the Russell 2000, it looks very similar, almost exactly the same. If you look at the Dow Jones Industrial Average, sorry. When you look at the Dow Jones Industrial Average, it's a little bit more bearish. The intermediate line is almost back below 20, and they're 4.5% below. The market sentiment line looks like it's about to turn over. It's still rising, but it's that close to turning over. And then, of course, short-term sentiment very bearish. So you can see, this is a pretty significantly bearish level. This is my last market outlook for the week. So just kind of give you an idea, because I won't be here on Friday. I'm off on Friday, so there won't be a market outlook over the weekend. I won't be back on Monday either, so there won't be a market outlook next Monday. So the next market outlook from me will be next Wednesday, so a week from today. So keep that in mind. Brandon will be doing his market outlook tomorrow, most likely, and then Tuesday of next week will be our next market outlook videos. To kind of give you an idea, I told you back in this period that was that bear tag either, like, basically the implications that bear tag has here on the weekly chart is that by the end of 2023 we're going to be like way bullish, like well beyond the 4,800 on SPX, like well beyond that level, or we're going to be mired in the bear market by the end of 2023. It depends on whether you can just keep going from there. But 5 weeks later, and we still got 2 days left this week, but 5 weeks later, we only had one bullish week, and we're well below the 2.5% mark, below the moving average. The intermediate lines, still below its market sentiment. They're both falling. The short-term sentiment still, bearish. They're both here in bearish territory. So again, depending upon how we finish, that suggests already that bear tag's not going to turn into a bull market, an extended, market sentiment run of like a year or more, up to new highs and beyond, right? That was the implication. It's one or the other. It wasn't just like, oh, we might be bullish or bearish next week. It's like we're either going to be super bullish by the end of 2023 or super bearish. It depends upon how we follow through with that tag. And we followed through just really crappily. By 2 weeks later, we were back below the low of that week, and the low of the previous week. And then 3 weeks later, we're at the low of the week before that, on that kind of breakout week. So two kind of breakout weeks that we've completely nullified. And now the question is whether we'll break back down below these, if not by the end of the week, by next week. That brings up, it's not the end of a month, but it is the end of an option expiration cycle. So when you look at that, you notice again, we have, the week's not over with, but we had a bull tag week. So this is the same thing. This bull tag either starts a really good long bull run, because the last one that we had was here in 2016. It either starts a really good long bullish run that in this case ended in 2018. And then we had that peak and then we're back up again. Or it starts the bear market, right? And again, in 2023, you're going to be way down. So you can see it there. And of course, if I were to go back to like 2000, oops, options expiration. You can see on that bear market, again, there's your bull tag that we got, and we never rallied, right? We just went down. Same thing here. We rallied a little bit, never got above that high point of the bull tag, never closed above that week, never closed above that week, and there we go. And so this month, excuse me, we actually did close above that month, so that of the bull tag. So looked really, really good, but just like that, we're back down, and this is about to end. So now it's really important that the next expiration cycle be a really bullish expiration cycle. The problem is, from a seasonality standpoint, that's just not necessarily the case, right? If you look at SPX, from this expiration cycle to October, we are bearish. For the end of September into the beginning of October, we tend to be pretty bearish before a little late rally that goes into October expiration. October expiration this year is the 21st, so we'd be right here, right there. So it's hardly a bullish. At best it's flat, and at worst it's a bearish period of time. You can see the VIX, from a seasonal standpoint, the VIX also tends to be pretty bullish here from the end of the week. This is actually in the next week, on the way up to the end of the month, into the beginning of earnings season, and of course into the 21st. So this is a bearish time of year. You wouldn't expect that we're going to get. And again, if we end up back below, like we already have on the weekly chart, right? So if we end up back below that candle that produced the tag, then we're going to be bearish. And the same thing on this case on the monthly chart. Again, that really important is a bull tag on this one. If we end up back below that, and I don't know if we'll do that by the end of next week or this week, but if we get down there by the end of the expiration cycle and we get below 2.5%, below the 30-month moving average, the month being options expiration months, then and that to kind of give you an idea of where that would be. Right now, it looks like the moving average is sitting here at 39. Let's see here. Looks like it's sitting at 39.2774. So 39.2774. 2%, 2.5% of that would be down to 38.2954. So that would be down 38.29. Would be down into this area right here. So if we get below these lines, we will be more than 2.5% below that 30-month. And again, that's by next expiration. That's not by next week or by the end of this week. It's by next expiration. Though it's pretty obvious that we can be down there by the end of next week or by the end of this week. That's because we're that close. So keep those. I mean, those are really important levels to watch for, to see how we finish out this week with this really bad inflation reaction, and then how we go into a new expiration cycle, which is seasonally a bearish expiration cycle. Let's take a look at the other weekly chart that we look at. We got green arrows. We got a higher close. We got a higher close again, so we got to close above this to reverse. These are transition candles. If we end up closing back below that candle on a Hakinyashi basis, then that we're back to being bearish. So keep in mind, like right now, next week's, as it stands, next week's candle will start off at about 40.24, 40.20 in that area. That's where the open will be next week. It's the midpoint of that body. And we're trading right now at 39.46, which is down in here. So, I mean, that's going to be, right as of right now, again, depending upon how we close, the Hakinyashi close here is at 39.81. That's where the Hakinyashi closes. We're already below that. So it kind of gives you an idea of just how likely we are to continue to the downside. Remember the PPO is already falling again. You got the bearish candle, you got the red arrow, you have a transition candle, but as of right now we have a bearish candle for next week. I mentioned that today was really important for the Arun indicator because that's the pattern where we have the green line at 0 now and the red line below 70. That's a recipe for a 4-week breakout to the upside. Well, we are nowhere near the 4-week high point. So we're not there on that. And then finally the whole moving average, again, you can see we flipped the parabolic SAR. We got the Hakinyashi close. We're below the 20-week 20 period whole moving average. So that's appears likely to turn over tomorrow. You can see that's where we are relative to the 200. But if you look at relative to the 20-day, we are just a little bit below the 20-day. Getting any further below will be more likely turn it around, especially with the parabolic SARs already having flipped and a pretty decent size candle again in a lower close. That's decent sized bearish candles and lower closes. Are bearish in this case. I want to look at the breadth here. So you look at the McClellan oscillator. We did not get strong bearish breadth. So again, we have to kind of get below. What'd you say? Maybe minus 35, minus 40. Same thing on the upside. Being at minus 15 is not enough. So that kind of gives you an idea of just how bearish we are. It's not that bearish from a breadth standpoint. The summation, however, is still negative. So that's unfortunate because we need it to be positive if we're going to be bullish. So that's still bullish there. The Ichimoku cloud, we are back in the cloud. So it was really nice that we were above the green, the cloud when it turned green. we are that close to breaking back below the cloud if we break below 3,900. We have a weak bearish trend, so we're below -1. We are above 55, so we're back to a weak bearish trend after losing it on that 4-day rally. We'll see what that turns into. The DMI, the negative indicator is still easily above 25. The positive indicator is just barely below it. So again, we're not that bearish until the positive gets below 25, and especially until it gets below 20. And even that, as you can see here, is not a guarantee. But you need that to be bearish, especially with the ADX already back below 20 there. You look at the RSI and the CCI, and you notice, again, we're pretty neutral. Like, we're between 40 and 60. We're between 100 and -100. So you kind of have to get below either -150 or above -150. You have to get below 40 or above 60. And as of right now, we're just in a very noisy pattern with the Bollinger Band, which is relatively high, dropping. So this is very common when a Bollinger Band's dropping, that we just kind of go up and down and sideways, right? And you can see how flat we are by the time we bottom out on the Bollinger Bandwidth. And right now, after peaking on the Bollinger Bandwidth in this area, now we're bottoming out. So we have some ups and downs, but you would expect that we'll kind of consolidate in this area until you at least break into the lower quartile, at least. And that's just not the case right now, right? And when you throw in the Keltner channels with that, you have bearish momentum. It's waning. You still have the bands outside the Keltner channels, but you're not below the Keltner channel. So again, we are just noisy. We're just consolidating. We're not pushing. As bearish as yesterday was, it was only bearish because of these irrational moves the days before. That's the only reason. Like, if we didn't go up as much, if we just kind of just went sideways and the market waited for the CPI, the market wouldn't have gone anywhere. That kind of goes to show, like, it was only that bearish because we were only stupidly bullish. That's it. And that's pretty much the same thing when you look at it from a long-term perspective, right? When you're looking at this weekly chart, we were like, how far away we are from the 200-week moving average here, simple moving average. We got up 40%. I mean, that's stupidly bullish. And so now we're only 10%, which is actually kind of normal. So this would be a pretty normal bullish trend, as it, normally. The only reason why it seems as bearish as it is because we were stupidly bullish before that. We rallied up way too much, and now we're regressing back to the long-term trend line. It's as simple as that, right? So you look at this here, we're just regressing back to what is a long-term trend line. We were just outside of 2 standard deviations previously, and now we're regressing. There's nothing, it's the same. That's a long-term scale, but as of right now, that's the same thing that's happening on a very, very short-term scale, right? We are just coming back down after being, wrongly bullish, apparently. Like, again, if we hadn't have rallied those 3 days, we wouldn't have fallen as much as we did. We wouldn't have this 4% rally if we didn't have 3 out of 4 1% rallies previously, when the market was ahead of a really, really important. The market was trying to front run that report, and it got caught way off sides, and of course it fixed itself. But like we've seen on other 4% declines or 3% plus declines, the next period is just a little small period. There's nothing really to worry about there. From a VIX standpoint, the VIX rolled over, so it actually kind of came back down. Not surprising, and again, it's not inverted. So like the yield curve, the VIX curve is not inverted. We're not above 100% here against the 3 months. So the VIX 3M still is very, very high. It's obviously still higher than this, which is not normal when you're this bearish, right? And it's definitely not normal. It's not normal for the VVIX to be this high when the VIX 3M to be this high when the VVIX is this low. You can see the last time we had the VVIX this low was in essentially going into 2019, going into the COVID move. For most of 2019, we were in this area. Well, if you look at the VIX 3M for most of 2019, we were below 20. So the fact that we're down there again on the volatility of the VIX, but we're still up at 27, so well up, still above 25, much less above 20, but above 25, which is rare normally, but it's very common lately, and that's a concern. And in fact, that's why I think that all of these are corrections. This does not look like a correction. It looks like eventually we'll begin this bear market based on what I told you with those long-term market forecast tags. Obviously, it's not going to, we're not going to have October 2008 next week. Right? I know we live in a binary world, especially with TV telling us we're either dropping to zero or we're shooting to the moon. That's not the case. So we're not going to tank. Remember, bear markets start very inauspiciously. They end very famously, but they start very inauspiciously. And so that's the case. And a lot of people, they think about it the other way around, and that's not the case, right? Because they think bear markets start like in October 28, 2008, and that's when they get out, only to be closer to the end of it than the beginning, and missing out on a lot of the bounce back in March of 2009. So I think we are closer to the beginning of the bear market based off what we're seeing here on the volatility of the VIX and the long-term volatility. In this case, the 3-month. If you look at the 6-month, it's even worse, right? We're well above 25 at 28. Again, when you look at the VIX, when the VVIX is down, the VIX 6M is down below 20. When the VVIX is at these levels, but the VIX 6M is still really high. Again, this is essentially a proxy for protection values, price protection for, in this case, 6 months out from now. Not just 30 days, which is the VIX, but 6 months out from now. It's normal for it to be higher than the VIX. It's not normal to be this high of the VIX when the VIX is where it's at, right? When the VIX is at these levels, and someone mentioned there's only been 2 times that we've had a 4% down day. So one of them is May 18th, and then yesterday, 2 times where we had a 4% down day, and the VIX did not close the day above 100%. So here is May 18th right here. So the VIX closed at 94%, didn't even get above 95. And then yesterday, the VIX closed at 97% relative to the VIX 3M. That's incredibly rare. It's the only 2 times ever since they started, since 2004. It's the only 2 times ever. So that includes the great financial crisis. So again, it's, in my opinion, another sign that we may be closer to the beginning of a bear market than we think we are. All right, now let's take a look at what's driving the price today. You can see real estate values were way down. The dollar was down relatively significantly for most of the day. Commodities, though, were bullish along with equities. Again, that's not been the normal pattern for most of the year. That was the pattern for the 2 days before Tuesday. So, and of course, yesterday broke and commodities way outperformed equities. But with equities rising along with commodities, that's not typical. That's not very typical, and you can see with bond yields falling too. Bonds and commodities rising together is definitely not typical. So very uncommon to see the type of pattern, and it's just a reminder that, remember, the whole bullish narrative for the Tom Lee rally, which is the name of the rally we'll get by the end of the year up to 4,800, right? That's the Tom Lee rally. What's going to fuel that rally, according to him, based on the macro, is that commodity prices are down from their highs, and that will bring rates down. The Fed will stop raising rates. That will bring rates down, and then we can be bullish on these high growth areas because they prefer lower rates. The problem is commodities aren't getting the picture, right? They did come down. They tested the 200-day moving average. They broke back above, and now even with yesterday's move, as bearish as we were yesterday, commodities are only slightly bearish. They way outperformed equities, and then holding that up now. I mean, the commodities traded within the upper end of yesterday's range, whereas stocks traded in the lower end. So, and again, we're close to getting above. We are above the 17-day moving average on DBC, and we are the MACD is above its moving average. So we have, that is a bullish divergence. Now we're not back above the 30-day, and we're kind of really small ranges, so we're half of normal. So I wouldn't, that's in very low volume. So I wouldn't say we're breaking out here, but we're not breaking down either, which is, again, the whole narrative for rates coming down. But as you can see, rates are not coming down. They're still easily above their 8-day moving average, or way up above their 8-week moving average. And as of right now, this would be the 1, 2, 3, 4, 5, 6, 7th week in a row that rates have rallied. So coming off of a low of 2.64%, now up to 3.41%. as the odds of a rate hike continue to move to the upside, right? We have, we were at 1 in 3 chance of a 100 basis point hike yesterday. We're in 1 in 4 chance now, so less likely, but obviously we are 100% chance of it fits 75 basis points, and that wasn't the case a week ago, and it definitely wasn't the case a month ago. A month ago, we only had less than a 50-50 shot of getting 75. Now it's 100%. And less than a month, now we also have, a 70% chance of getting a 75 basis point hike in November. And a month ago, it was a 0% chance that we were going to get we've gone up to 60, 70%. We've gone from 0 to 70% in a month. We've gone in a week. We've gone from 1.5 to 70% in a week. So the Fed is, anticipated to be strongly bullish here. A week ago, we had a 1.5% chance of being at 4.25%. So that 425, that would be 175 basis points from here. That's a 75-75, or at least 75-50-25, or 75-75-25. Or excuse me, 75-50-50, or 75-75-25. Which is, again, 70% chance of that latter being the scenario. So we've gone from 1.5% chance of 175 more basis points by the end of the year to a 89% chance in just a week. So the odds of, we were kind of flirting with going in the other direction here a month ago, and now we are up here. So all of these at 350, 375 are down here at 425, 450. So, I mean, shoot, there's a 47% chance, which is a coin flip, of getting 200 basis points. And again, in my experience, the Fed doesn't end rate hike cycles with its smallest rate hike, unless it's been the same the whole time. If they ramp it up, like they've done here, they've gone from 25 to 50 to 75. If they ramp it up, they tend to end on their biggest rate hike. So, so whether they go 75 and then 100 or whatever the case is, I mean, that's the past precedent, and then they stop because they generally have gone too far. And obviously they had, like the bond market says they are, like the yield spread's negative. So the bond market is priced in terminal rate hike here. And you can see the 10-year yield is currently at 3.4%, but even that's got, another almost 100 basis points to go to get to where the futures market is pricing in its terminal rate hike. To 425. So it's got, about another 60 plus, maybe 75 basis points left to go. And of course, the 3-month is the 3-month. I mean, the 3-month is the highest level it's been since 2007. That's a high level. Like, again, like the investors for most of this period from 2008 all the way up to now, this year, so it's almost 13, 14 years. There's only a brief period of time where investors had a choice between what to do with their money over 3 months. Keep it in the stock market and get a 1.2% divided by 4, because right now the spread on SPY, the yield on SPY is 1.2%. So right now you have a choice of getting a 0.3% yield for the next quarter for 3 months, and then whether stocks are up or down at the end of the 3-month period remains to be seen. Obviously, you would have to bank on it being lower than higher based off the current trend, but you don't know what your principal is going to be at the end of the 3 months, or you can have your principal guaranteed and preserved. You won't get any return, the price won't appreciate, but at least you'll get your principal back, and you'll get a 3.26% return, 3.2% return, which is over 10 times what you would get from the yield of SPY. So, I mean, finally, the market has a choice between what to do with its money in the short term, between bond market or cash and stocks. And that has not been the case for years. That has not been the case, except for a small period. But even that wasn't too attractive because we were bullish in the markets. And, really wasn't until 2018 but even that, December of 2018, you were bullish. You were coming off a correction low point. And then we had, the COVID crash. And of course, we're back to 0% interest rates. So that's an important decision that actually will draw interest away from the stock market that we haven't had to worry about for a long, long time. Again, pretty much since 2007, when the choice was a 5% return over whatever the 3-month yield was for the S&P 500. Let's take a look at how the sectors are doing here. So let me pull up the sector charts. So bear with me 1 second. Right, and then we'll just look at today, September 14th, and we'll come up to like a 2-minute chart. All right, you can see our big winner, of course, was energy, not surprising. We'll take a trade today in the energy sector. It is surprising to see utilities up here with discretionary, and the technology and communication services pretty much matching the market, and then real estate and materials. So for materials not to be up with energy kind of suggests that this isn't really a bullish cycle for whether it's a late stage or a coincident stage. You know, industrials and financials are kind of more early stage, and XLK and technology is more kind of a coincident stage, later stage, and then of course materials and energy are the way late stage, and along with industrials. And then of course your safe havens. Your safe havens are the, you know, after that, right? They tend to be your better. They preserve the value better when we are in a down cycle. So to not have materials up with energy, and it's actually the outlier to the downside, and to have utilities up here, and again not down with real estate, means that today was not a typical risk on day. And so I wouldn't put much into it. And again, putting it in context of what we did yesterday, you can see energy actually finished this 2-day period bullish. Isn't that crazy? It was down 3%. And just like that, the energy finished the day, this last 2-day period, bullish. And it was the only one that was bullish. It was the only one that was even close to being bullish. Utilities are down 2%, not surprising. Healthcare and staples also holding value well. And you can see your sectors down here, technology, discretionary, communication services, still really either matching the market or really lagging over the 2-day period. So it goes to show that, you know, today wasn't, I mean, if we were going to be bullish, we need to be a lot better than this. We don't necessarily need to be like energy, but a lot of these areas down here need to be kind of where utilities are, and obviously not the case. All right, that brings us to our trade idea of the day, and let's take a look at Schlumberger. It's energy has been doing really well. It's got dark green shading, a green line. The intermediate line's rising. It's actually almost above 80. Market sentiment suggests that it's got, like, this was a market sentiment decline for, I mean, we were bullish, we went sideways, we tried to break out, it was a fake out, but now we're coming back up to those levels again. Market sentiment's rising, suggesting that, you know, this is a run that could last for a while. This, like, again, remember, in 2008, energy stocks did very well at the beginning of the bear market. So it appears to be the case again. If you look at, you know, where we are with 3 green arrows, we actually do have 3 green arrows because the MACD is back to being positive and the stochastics is rising. We are easily above the 8-day moving average and the 17-day, and we're above the point of control and working our way up to the upside. Obviously, you know, we were in a sideways trend before this fake out volatility, and now it seems like we're back up into this trend, and we're still at the low end of it, and you can see where the high end of it is, pretty much at the top of the value area with the centered around the point of, right now we're centered on the point of control over the past year. If you look at like some of these oscillators, they're very neutral, right? You can see we're, you know, at the top end of neutral range, but we are still in neutral territory for both of those. And you look at the DMI, and they're both falling towards 25 and less, and the ADX is extremely low with the Bollinger Bands, the bandwidth low and falling, right? So that suggests that we're consolidating around this point of control. After this, you know, after this volatility, we're consolidating. And I think that's probably your best case scenario if the markets tend to be more bearish, is for consolidation. So what I decided to do for this trade was to do a iron condor spread. So if I come back down and sell the 37.5, so right in that 30 delta, buy the 35, and then come over here and sell the 25 delta, so a little bit lower, and then buy the 47.5. What that does is, see, here's the market. It gives me more upside room for it to rally with my break even on the downside a lot closer. And that makes sense because, you know, I've got all the moving averages below the price right now, including the point of control and, you know, Fibonacci support and everything. Like if you look at, if I were to remove that drawing and draw the Fibonacci support on this breakout that we had here, you can see I've got the 62% retracement level down there. I've got a lot of support below, and I've got some resistance above us, but not as much. But I do have the top of the range, and I even have that fake out, this 23% line up there as well, where my break even is on the upside. So I have room to expand, but a lot of support below me to keep me up above that. So, and again, if it doesn't work out, I position size to take. And I'm willing to take a $693 loss up to a $693 loss because that's what I'm trying to make. So that's a pretty decent return for $1,000 of risk. It's more than double what we normally try to get with $1,000, as long as we kind of continue to consolidate again around the point of control with the falling averages. You can see even the trend strength indicator is on the we're not like we got up to this 2 level and 65, but instead of continuing and really maintaining a strong trend, we just kind of went sideways, and we're kind of stuck in the cloud. And I expect that we'll probably stay around the cloud for the next little bit. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have there. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at marketscholars.com for free. Follow us on Twitter and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next week.